All right, so you're building a SaaS company. You're deep in the trenches, focused on product, customers, and growth. But have you ever stopped and asked yourself that one huge question? What is this thing actually worth? Well, today we're going to pull back the curtain on that. We're going to demystify SaaS valuation, breaking down the exact metrics and models that buyers use. By the end of this, you won't just understand your valuation, you'll know how to improve it. Okay, let's just dive right in. Look, valuation isn't some kind of secret dark art. It's really just a language. And it's a language that every single SaaS founder needs to become fluent in. Because knowing your company's worth isn't just for some far-off exit someday. No, it helps you make smarter, better decisions every single day. So let's learn the language.
So first things first, you got to understand there is no single magic formula for valuing a SaaS business. It's just not one size fits all. The way a potential buyer looks at your company is going to change dramatically based on your size, how fast you're growing, and of course, your profitability. The trick is knowing which lens they're going to use to look at your business. And to figure that out, we need to get into the 3 fundamental ways that buyers actually measure value and analyze a SaaS business to land on a number.
Here are the big 3. First, you've got SDE, which stands for Seller's Discretionary Earnings. Think of this as the method for smaller owner-run shops, where the owner's salary, maybe a car payment, that stuff gets added back into the profit number. Then there's EBITDA. That's earnings before interest, taxes, depreciation, and amortization. This is the gold standard for more established companies that have a management team in place. And finally, you have revenue multiples. This is what you see with those fast-growing companies that aren't profitable yet. It's all about valuing their momentum.
This chart really simplifies how a buyer thinks. I mean, look at it. Is the whole operation totally dependent on you, the owner? They're going to use SDE to figure out the real cash flow. Are you making consistent profits with a solid team? Yep, they're looking at EBITDA to gauge your operational health. And are you just growing like a weed? Then they're going to slap a revenue multiple on you to put a price on that growth. It's like a logic puzzle. And this right here is the answer key. And this quote, this really gets to the absolute heart of it all. At the end of the day, valuation is all about pricing risk. The more unpredictable your business seems, maybe you've got high churn or everything falls apart if you go on vacation or your books are a mess, the lower the multiple a buyer is going to offer. It's that simple. Your job is to build a rock-solid case for stability and predictable results. Okay, so how do you prove that stability? How do you build that case? Well, you do it by mastering a few key metrics. Let's dive into what I call the vital signs of your SaaS company. These are the numbers that tell 80% of the story. If you nail these, you are well on your way to a fantastic valuation. And we have to start with the big one, ARR growth. This is so much more than a vanity metric. It's the loudest, clearest signal you can send that the market desperately wants what you are selling. To a buyer, seeing strong, consistent ARR growth is powerful, undeniable proof of product-market fit and some serious momentum. And here's what that growth actually looks like in the eyes of an investor. If you're chugging along at less than 10% a year, they're going to see that as stagnation. But once you cross that 20 to 40% threshold, okay, now you're in the solid and scalable club. And if you're hitting 40% or more, that's when you get to have conversations about premium, top-tier valuations. All right, next up, retention. Now, this can get a little confusing, so let's break it down. Think of gross revenue retention, or GRR, like a bucket with a few tiny leaks. It tells you how much of your revenue you're holding onto, even with customers naturally turning out. It shows your stability, but net revenue retention, or NRR, that's where the magic is. That's the same bucket, but now you're also adding more revenue from the customers you already have, through upgrades, expansion, you name it. NRR shows whether your customer base is actually getting more valuable over time. And this is exactly why retention matters so much. Come on, we all know getting new customers is crazy expensive. If you can't keep the ones you've already won, you're just stuck on a growth treadmill, running faster and faster just to stay in the same place. For a buyer, high churn is a massive, flashing red light that something is wrong with the product. So the holy grail is getting your NRR over 100%. And if you can get it to 115% or higher, well, you're in the elite tier. Think about what that means. It means that even if you didn't sign a single new customer all year, your business would still grow just from your existing customers. That is an unbelievably powerful story to tell a buyer. Okay, let's talk about the constant balancing act, growth versus profit. The rule of 40 is this awesome, quick health check that investors absolutely love. The formula couldn't be simpler. Just take your ARR growth rate and add your EBITDA margin. It's a beautiful way to see if your growth is healthy and sustainable, or if you're just, burning piles of cash to get it. So, what's a good score? Well, here's the breakdown. If you're under 20%, you've probably got some work to do. Either your growth is slow or your costs are too high. But if you can get past that 40% benchmark, you are showing an incredibly healthy, efficient balance between growing fast and staying profitable. And that commands a premium. So we've balanced growth with profit. Now let's look at the engine itself, the LTV to CAC ratio. This basically compares how much a customer is worth to you over their lifetime versus how much it costs you to get them in the door. It answers the most important question of all. Is our growth machine actually profitable and repeatable? And here's the magic number you're shooting for. You really want your customer's lifetime value to be at least 3 times what you paid to acquire them. Anything less than that, and it starts to look like your growth strategy might not be sustainable. But a ratio of 3 to 1 or higher, that is a beautiful sign of efficient, scalable, and very, very attractive growth. All right, we've gone through the metrics, we've learned the language of valuation. Now for the fun part. Let's turn all this knowledge into an actual plan. Because, look, knowing your numbers is great, but improving them, that's where you build real, tangible value. Here's a super simple 4-step playbook. 1, find your weakest metric and attack it. Is your churn a little high? CAC creeping up? Pick one thing. 2, build a 90-day plan. Not some huge, year-long strategy, but a focused, intense sprint with a clear finish line. 3, start looking at your own business through the eyes of a buyer. Be critical. Where's the risk? And 4, start getting your documents together now, not when you're in the chaos of a potential deal. And that last step, it is all about credibility. Seriously, imagine walking into a meeting with clean financials, detailed reports, all your contracts in a row. It just shows you're a pro. It makes the whole due diligence process smoother and builds a massive amount of trust with a potential buyer before you even start talking numbers.
We have covered a ton of ground, from the big picture frameworks down to the nitty-gritty metrics. But really, it all boils down to this: taking focused, deliberate action every single day to build a stronger, more resilient, and ultimately a more valuable SaaS company.
So I'm going to leave you with this question. Just one question. Don't try to boil the ocean and fix everything at once. Just look at your business right now. What is the one metric, whether it's your retention, your CAC, your growth rate, that if you could just move the needle on it in the next 90 days would fundamentally change your company's story? Find that one thing. That's your starting point. That is how you take control of your valuation.